Welcome to Day 23 of Future Business School's Daily MBA series. Today, we'll be covering a crucial aspect of financial management, working capital management. We'll explore how to effectively manage cash flow, inventory, and receivables to ensure a company's smooth operation and financial stability. What is working capital management? Working capital management involves managing the short-term assets and liabilities of a company to ensure it has sufficient liquidity to carry out its day-to-day operations. Effective working capital management ensures that a company can meet its short-term obligations while maximizing its profitability. Key components of working capital management: cash flow management, inventory management, receivables management. Let's break each component down. 1. Cash flow management. Cash flow management involves monitoring and optimizing the inflows and outflows of cash to ensure a business has enough liquidity to meet its short-term obligations. Key concepts: cash flow statement. A financial statement that provides a detailed analysis of what happened to a business's cash during a specific period. It includes cash flows from operating, investing, and financing activities. Cash flow. Forecasting, predicting future cash flows to ensure the business will have enough cash to meet its obligations and avoid potential liquidity issues. Example: imagine you run a small retail store. You need to manage cash flow to ensure you have enough cash on hand to pay suppliers and employees. If you notice a dip in sales, you might forecast a cash shortfall and take actions like negotiating better payment terms with suppliers or securing a short-term loan. Real-world example: Apple's cash management. Apple Inc. is known for its robust cash management strategies. They maintain substantial cash reserves, which allow them to invest in new projects, weather economic downturns, and return value to shareholders through dividends and share buybacks. Inventory management involves overseeing the ordering, storage, and use of a company's inventory to minimize costs and meet customer demand effectively. Key concepts include the inventory turnover ratio, which measures how often inventory is sold and replaced over a period. A high ratio indicates efficient inventory management. Formula: inventory turnover ratio equals cost of goods sold divided by average inventory. Another important concept is the economic order quantity, or EOQ, which is the optimal order size that minimizes the total inventory costs, including ordering and holding costs. Formula: EOQ equals the square root of 2 times demand times ordering cost divided by holding cost. Where demand is in units, ordering cost is per order and holding cost is per unit per year. Just-in-time, or JIT, is a strategy to reduce inventory levels by ordering and receiving inventory only as needed for production or sales. For example, a manufacturing company might use EOQ to determine the ideal order quantity for raw materials to balance ordering and holding costs. If they order too much, they incur high holding costs, but if they order too little, they might face production delays. A real-world example is Zara's inventory management. Zara is renowned for its inventory management practices. The company uses a just-in-time approach to keep inventory levels low while quickly responding to fashion trends. This strategy helps Zara reduce holding costs and avoid excess inventory. Receivables management focuses on efficiently collecting accounts receivable to ensure that cash is collected promptly and to minimize bad debts. Key concepts include Days Sales Outstanding, or DSO, which measures the average number of days it takes to collect payment after a sale. Formula: DSO equals accounts receivable divided by total credit sales multiplied by days. Another important tool is the aging schedule, a report that categorizes a company's accounts receivable based on how long invoices have been outstanding. It helps in identifying overdue accounts. Credit policy is also crucial, as it includes guidelines for extending credit to customers, including terms of payment and credit limits. For example, if a company's DSO is high, it may need to improve its collection processes. This could involve sending reminders earlier offering discounts for early payments, or revising credit terms. A real-world example is General Electric's receivables management. General Electric, or GE, uses sophisticated receivables management practices to streamline collections and manage cash flow. They employ credit analysis and collection strategies to minimize days sales outstanding and ensure timely payments. Effective working capital management is essential for maintaining liquidity, ensuring operational efficiency, and supporting business growth. By focusing on cash flow management, ensure you have enough liquidity to meet your obligations and invest in opportunities. Inventory management. Optimize inventory levels to reduce costs and meet customer demand. Receivables management. Improve collections to maintain a healthy cash flow and minimize bad debts. By carefully managing these components, businesses can enhance their financial stability and operational efficiency. Thanks for joining us today on Working Capital Management. If you found this video helpful, please like, share, and subscribe to Future Business School for more insightful content. Tomorrow, we'll be covering mergers and acquisitions. Stay tuned.